feels like now, maybe more than ever, that more dividend income focused investors are becoming impatient and seeking out alternative investment options, which can in theory offer much more dividend income from the start. And to be fair, maybe for good reason. With alternative investments like the yield max ETFs, for example, these more option focused ETFs are offering distribution rates upwards of almost 70%. Where of course more traditional investment options like the Schwab US Dividend Equity ETF, known as SCHD, which is offering dividend-focused, more income-focused investors more of a measly starting yield of around 3.5%. Now in this video, we are going to go through one of the more alternative options when it comes to super high dividend yields right off the bat. Dig deep into the ETF and explain exactly how it works. Then after that, we're going to go through one of the most popular, more traditional options that most dividend growth investors, including myself, have been investing into for years. Then towards the end of the video, we are going to break down the exact math of what an investor in theory could expect by investing just $1,000 into each one of these options and see exactly how much dividend income they could generate consistently. Now stick around because we have a lot to go through. Right after you, please drop a like in this video and subscribe for more future content like this. So let's first talk about one of the more alternative investment options for dividend growth investors or income focused investors that want big juicy dividends right now. TSLY is a yield max Tesla option income strategy ETF, and this ETF has a distribution rate of around 69.5%. It pays a dividend monthly and uses a cover call strategy to do so. What do you say we look a little bit deeper into this ETF and explain exactly how it works? First things first, heading over to the YieldMax website where TSLY has all the information we're going to need. Wasting no time and opening up the YieldMax TSLY Tesla Option Income Strategy ETF prospectus. It says investment objective. The fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to share price of the common stock of Tesla, or TSLA, subject to a limit on potential investment gains. Now, as far as fees go with this ETF, it is going to be a pretty massive fee of 0.99%, but as you keep watching this video, you're going to understand exactly why. It then says principal investment strategies. The fund is an actively managed exchange traded fund that seeks current income while maintaining the opportunity for exposure to share price, i.e. the price return, of the common stock of Tesla, or TSLA. Subject to a limit on potential investment gains, the fund will seek to employ its investment strategy as it relates to Tesla regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take temporary defensive positions during such periods. So that's very important. No matter what happens in the market, TSLY is going to stick with the strategy and keep it moving regardless. Now, this is a very important part of this ETF, so listen closely. It says the fund uses a synthetic cover call strategy to provide income and exposure to the share price returns of Tesla, subject to a limit on potential investment gains as a result of the nature of option strategy it employs. The fund's options contract provide, number one, exposure to the share price returns of Tesla, plus current income from the option premiums and a limit on the fund's participation in gains, if any, of the share price return of Tesla. So next, this is also important. Why invest in the fund? The fund seeks to participate in a portion of the gains experienced by Tesla, which a lot of everyday investors, including myself, are definitely interested into. The fund seeks to generate monthly income, which is not dependent on the price appreciation of Tesla. So because of the synthetic cover call strategy, Tesla doesn't necessarily need to move up in price for the fund to generate a lot of money for investors, which is also very appealing. It then says although the fund may not participate in gains of Tesla's stock price, the fund's portfolio is designed to generate income from it. It then says an investment in the fund is not an investment in Tesla. This is maybe the most important part that a lot of people are getting very confused about. The fund strategy will cap its potential gains if Tesla's share increases in value. And that's because of the cover call strategy. Now, the fund strategy is subject to potential losses if Tesla's shares decrease in value, which may not be offset by the income received by the fund. So this is no different than any other cover call strategy for the most part. If the underlying loses a massive amount of value, even though the cover call seller has a bit of downside protection and earned the premium, it doesn't necessarily mean that the whole strategy isn't going to lose value. Also very important, it says the fund does not invest directly into Tesla. Fund shareholders are not entitled to any Tesla dividends. It says as part of the fund's synthetic cover call strategy, the fund will purchase and sell a combination of standardized, exchange-traded, and flexible exchange call and put option contracts that are based on the value of the price returns of Tesla. In general, an option contract gives the purchaser of the option contract the right to purchase for a call option or sell for a put option the underlying assets like shares of Tesla at a specific price known as the strike price. Now, the synthetic cover call strategy is what this ETF uses. So it says in seeking to achieve its investment objective, the fund will implement a synthetic covered call strategy, using the standardized exchange-traded and flex option strategy above. So a traditional covered call strategy is an investment strategy, where an investor, the fund, sells a call option on the underlying security it owns, and that's something that I do throughout my portfolios on a regular basis. A synthetic covered call strategy, something I don't do, is similar to a traditional covered call strategy that an investor sells a call option that is based on the value of the underlying security. However, in a synthetic covered call strategy, the investor, the fund, does not own the underlying security, but instead synthetically replicates 100% of the price movements of the underlying security through the use of various investment instruments. So the fund synthetic covered call strategy consists of the following three elements, each of which is described in greater detail further below. So a synthetic long exposure to Tesla, which allows the fund to seek to participate in changes up or down in the price of Tesla stock. Then on top of that, a covered call writing, where Tesla call options are sold against the synthetic long option of the strategy, which allows the fund to generate income. And then on top of that, some of the fund is going to be US Treasuries, which are used for collateral for the options, which also generate income. So now that we understand exactly how TSLY works, looking at its performance year to date, this ETF is actually up 7.32%, which is surprisingly outperforming lots of other ETFs across the board. But on the max time frame, this ETF has seen some price decay, down around 33.95%. But because this ETF does pay such massive dividends on a monthly basis, we can go through and see. If we use the total return metric to see what the real performance of TSLY has been year to date and beyond, with dividends and price return combined, total return for TSLY is 64.57% year to date, which is outperforming pretty much everything across the board in the markets. Now I get it, I know what you're saying, well, this ETF has not even been around all that long, and we can't really just go off of the first year or so's performance to predict exactly what this ETF is going to do in the future, and of course, how it's going to perform long term. And I would say you are 100% spot on correct. But just as of going off of this ETF's performance so far, this covered call strategy, combined with Tesla, has performed very well and has given investors that got in a little bit early a massive return, at least as far as year to date. So now that we dug into TSLY, explained how it worked, and even looked at how the ETF has performed on multiple time frames, let's dig into one of the most popular dividend growth styled ETFs that income-focused investors like myself, and I'm sure like many of you, have been investing into for a long time and dearly love. We're talking about the Schwab US Dividend Equity ETF, known as SCHD. Now this ETF strategy and objective is pretty straightforward. The investment seeks to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. To pursue its goal, the fund generally invests in stocks that are included in this index. The index is designed to measure the performance of high dividend yielding stocks issued by U.S. companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers. Based on financial ratios, the fund will invest at least 90% of its net assets into stocks. Now, some more highlights about this ETF: a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. Tracks an index focused on quality and sustainable dividends, and invests in stocks selected for fundamental strength relative to its peers based on financial ratios. So now that we went over SCHD, explained how the ETF works and some of what the ETF has to offer, looking at the Schwab US Dividend Equity ETF's performance year to date, it's pretty sad to see. This ETF is down 2.19% year to date. So even just going off of price return, comparing TSLY to SCHD is not holding up that well so far. But of course, the max time frame, we have lots more historical data to go off of because SCHD has been around for a very long time. This ETF, as far as just price return, is up 183.7%, which is very respectable. And again, this is not even dividends included. Now, investors buying into SCHD are getting a starting dividend yield of around 3.5%. So much different of that than investors would be getting buying into TSLY. But for long-term investors like myself that have been buying shares of SCHD for a very long time now, they're buying into a nice high-quality basket of stocks that have stability, an ETF that has had sufficient dividend growth over time, and of course massive growth long-term just off the ETF price. But that being said, comparing SCHD's total return to TSLY's total return on the year-to-date time frame is absolutely shocking. SCHD is down around 1%, while TSLY once again is up almost 65% year-to-date. Now, of course, this is comparing apples to oranges, as these two ETFs don't even have the same strategy and really for the most part have nothing to do with each other. But the reason I like to compare these two is because the dividend growth community as of recently has been very infatuated by TSLY and all the yield max ETFs And of course, I think it's safe to say that the entire dividend growth community of investors are overall a fan of SCHD. But I promised that I would explain exactly how much an investor, in theory, could expect to earn monthly as far as dividends go by investing $1,000 into SCHD versus $1,000 into TSLY. So SCHD for starters, $1,000 into the ETF would buy you around 13.5 shares of SCHD. Now SCHD doesn't pay a dividend monthly, but it does pay around 66 cents or so quarterly. At least that was the last dividend payout. So going off of 22 cents per share per month, let's just say, by spending $1,000 in SCHD, a dividend growth, more income focused investor could receive around $3 a month on average of dividends moving forward. Now if the same investor wanted to spend $1,000 and buy shares of TSLY, they could in theory buy over 70 shares of TSLY because of the really cheap share price. Now TSLY does pay monthly, and the last dividend paid was 83 cents per share per month. So in theory, an investor spending the same $1,000 could earn around $58.24 per month, just going off of the previous numbers. So that means in theory, an investor could earn an extra $55 a month if they were to invest in TSLY versus SCHD. Now, of course, the reality is that TSLY has not been around as long as SCHD, and again, the strategies and performance are likely going to look much different long term. And for me personally, just my risk profile and my overall strategy, I would much rather have a big portion of stability in my portfolio with an ETF like SCHD, for example, than have a ton of TSLY in my portfolio that's much more volatile and is going to pay me a different amount of dividends on a monthly basis that could be very drastic. But it just does go to show that there are different income-oriented options throughout the market these days. And what I've noticed as of recently is a lot of more income-focused investors are definitely taking advantage of it. But I want to hear from you guys down below. If you only had $1,000 to invest in theory, and you could only invest in either TSLY or SCHD, which of the ETFs would you buy into, and let us know why. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.